Welcome back to Explain the Charts, everyone. Today, September 12th, 2025, we're taking an in-depth look at the USDCHF currency pair, dissecting both the recent news and the revealing chart data. The USDCHF has been a hot topic, showing considerable volatility and a clear downtrend influenced by global economic shifts. Let's start by examining the fundamental drivers at play, primarily focusing on the US dollar's recent weakness. Recent headlines highlight increasing fears of Federal Reserve interest rate cuts, fueled by a surprisingly soft non-farm payrolls report that showed only 22,000 jobs created against an expectation of 75,000. This week's jobs data, coupled with a rise in the unemployment rate to 4.3%, has significantly bolstered market expectations for as many as 3 rate cuts totaling 70 basis points by year-end, with a 10% chance of an aggressive 50 basis point cut as early as September, especially if inflation data remains soft. Adding to the bearish sentiment for the dollar, a mixed U.S. durable goods orders report for July 2025 indicated a 2.8% decline, signaling a cooling demand contraction. However, it's worth noting that non-transportation orders showed some resilience, increasing by 1.1%, suggesting a somewhat stabilizing manufacturing sector despite the overall retreat. Now, let's pivot to the Swiss franc, which has been firing on all cylinders according to analysts, gaining significant safe haven appeal. Investors are increasingly flocking to the low-yielding CHF amidst concerns about the U.S. economy and geopolitical uncertainties. Switzerland's political stability and neutrality, combined with its strong economy, make the franc an attractive alternative asset. The Swiss National Bank has already cut interest rates to zero and might even consider pushing them into negative territory, yet the CHF's relative strength persists due to the broader dollar weakness. These fundamental factors paint a clear picture of a bearish environment for USDCHF, leading to its significant plunge, a 14% decline from its year-to-date high of 0.9200 seen in February. Now, let's translate these news events into the technical language of the charts, starting with the daily view of USDCHF. Looking at the one-day chart, we can clearly see the persistent downtrend that began earlier this year, aligning perfectly with the news of the 14% decline. The peak around 0.9200 in February has since given way to a series of lower highs and lower lows, indicating strong bearish momentum. A critical support level that we identified from the news reports is around 0.7870, which aligns with the low reached on July 1, 2025, a price level that could be a significant target for sellers if the downtrend continues. The pair has recently been trading around the 0.79 to 0.80 region, with some technical analysis suggesting immediate resistance at 0.8065 and near-term support around 0.8020. The strong downward pressure is further confirmed by the price trading consistently below its 50-day and 25-day exponential moving averages, as mentioned by various market analysts. Just recently, on September 9th, we saw the price touch a low of 0.7913 before a slight recovery, highlighting the volatility even within this strong trend. The candle for September 11th shows a notable dip, closing lower after some significant intraday movement. Shifting our focus to the 15-minute chart, we can observe the immediate price reactions to real-time events, which provides crucial insights for intraday traders. Here, we've filtered the view to highlight the price action on September 11, 2025, a day when the US CPI report was due. Notice the sharp decline around 12:16 Universal Time coordinated on September 11th, where the price plummeted from around 0.79989 to 0.79811. This rapid sell-off is a direct correlation to the CPI shock sends US dollar to Swiss franc plunging headline we discussed earlier, demonstrating how quickly market sentiment shifts with key economic data. The pair then continued to slide, reaching lows around 0.7967 before some attempts at consolidation. For intraday traders, these sudden moves emphasize the importance of monitoring economic calendars and managing risk around high-impact news releases. Currently, within this shorter time frame, Immediate resistance appears around 0.799, with support tested repeatedly near the 0.795 to 0.796 area. Now, let's zoom out slightly to the 1-hour chart, keeping in mind that the available data for this time frame extends only up to August 27, 2025. Despite this slight temporal lag compared to the daily and 15-minute data, this chart still offers valuable insights into intermediate trends and intraday structure before the most recent events. Between August 22nd and 27th, we can see USDCHF trading in a range, generally between 0.803 and 0.806. This period shows a relatively flat to slightly declining trend, highlighting a phase of consolidation or indecision before the more aggressive drops we've seen on the daily chart and the very recent 15-minute action. At that time, the price was above the 55 EMA but below the 200 EMA and 365 EMA, indicating a mixed trend, but with longer-term bearish pressure still evident. This reinforces the idea that while short-term price action can be choppy, the broader market sentiment, driven by those fundamental factors, was already leaning towards dollar weakness. The mention of choppy and indecisive price action in late August news reports aligns well with what we observe on this hourly chart, where the pair was repeatedly trading above and below its hourly moving averages, lacking strong directional conviction. Pulling all this information together, let's discuss potential scenarios for USDCHF. Short term, the sentiment remains largely bearish. The likelihood of further Federal Reserve rate cuts, combined with the Swiss franc's strength as a safe haven, suggests continued downward pressure. We could see a retest of the key support at 0.7910, or even lower towards 0.7870, a target that has been consistently mentioned by analysts. A decisive break below 0.7910 would strongly reinforce this bearish outlook, potentially opening the path to the psychological 0.7800 level. However, a short-term rebound towards resistance levels such as 0.7985 is also plausible, especially if today's US PPI or University of Michigan consumer sentiment data come in surprisingly strong. For traders looking for selling opportunities on rallies around these resistance levels, perhaps with a stop-loss around 0.8048 to 50 as suggested in one analysis, could be a viable strategy. Long-term, the trend remains bearish unless there's a significant shift in the economic narrative, such as a surprising resurgence in U.S. inflation or a hawkish pivot from the Federal Reserve, which seems unlikely given current data. Conversely, if the market's dovish pricing for the dollar becomes overstretched and upcoming U.S. data suggests stronger economic activity, we might see some of those anticipated 2026 rate cuts priced out, offering a window for a USDCHF rebound. Therefore, continuous monitoring of U.S. economic indicators, especially inflation and employment reports, is paramount. Key price levels to watch in the immediate future are the support zone around 0.7910 and 0.7870. On the upside, 0.7985 and the more distant 0.8065 will act as strong resistance points. Remember, trading involves risk, and these are potential scenarios based on the current data and news. Always conduct your own due diligence and consider your risk tolerance. Thank you for joining Explain the Charts for this comprehensive analysis.